What's going on, everybody? Welcome back to the channel, the Butterfly Monkey channel. Today, we will be going on part 8. Again, American Jurisprudence on Business Trust, volume 13. And it will be on taxation. So hopefully you guys have enjoyed the other videos. And this section right here will give you more of a realistic idea of how these organizations, right, these trusts operate. So this section, section 83 generally, goes on. The motive in forming a business trust is generally not considered by the courts in determining its validity, and it has been held that a business trust is not rendered illegal because of the fact that it was formed for the express purpose of reducing or avoiding taxation. That's literally the first sentence in this section. But although the business trust once enjoyed certain tax advantages as compared to corporations, a factor which contributed largely to the rapid spread of this organization as a vehicle of commercial endeavor, the general trend of legislation in recent years has been to minimize or remove entirely any such advantage inherent in the business trust. A significant exception to this trend has been the enactment in 1960 of certain sections of the Internal Revenue Code. Now, again, they said a significant exception of what they just said, entitled Real Estate Investment Trust, which are the REITs, which may well result in renewed interest in the business trust because of income tax advantages offered to shareholders in associations of this nature which invest in real estate and choose to qualify under the Act. So here you go. It's specific. Choose to qualify under the Act. So that means under statute, there's a specific criteria of a business trust that under federal law that they created for you to use. That is a federal benefit. And let's see if we can find it real quick. It'll be 26. Let's go like this. Title 26 Real Estate Invest Trust. Let's see if it comes up. Section 856. I think it's going to be under the regulations then. How I'm looking for specifics. But this is what I wanted to show. So here it is, right? Definition of real estate investment trust. In general, for the purpose of this title, the term real estate investment trust means a corporation, trust, or association which is managed by one or more trustees or directors. That's one criteria. The beneficial ownership of which is evidenced by transferable shares or by transferable certificates of beneficial interest. So, keyword here is transferable. Which, but for the provisions of this part, would be taxable as a domestic corporation, which is neither a financial institution referred to in this section, nor B, an insurance company to which subchapter L applies, the beneficial ownership of which is held by 100 persons or more. So the benefit from this organization here, you have to apply these 7 things. 6, subject to the provisions of subsection K, which is not a closely held as determined under subsection, so closely held corporation or whatever other entity. And 7, which meets the requirements of subsection C. So you got K and C. And here are the limitations. I encourage you guys to read up on this. If you guys do, I just want to get that first point across. And all this part is C. So all of that right there is all Part C. So this is the indenture. No bullshit. This is the indenture right here. They wrote it down for you. Parts or subsection C is the indenture of this form of entity. In some states where the use of the business trust has been restricted or precluded, legislation has been adopted or proposed to enable such associations to take advantage of the tax-saving features of these federal statutes. I mean, this should be a given by now if you guys have suffered through my last 10, 11 videos on business trust so far. The footnotes don't really give nothing, but they do give you that such legislation has been enacted in Texas. Right, so this, in some states where the use of the business trust has been restricted or precluded. Section 84, taxation as partnership or corporation generally. This you should already have an idea from, of course, the other videos that I made for the sections, the earlier sections of this book. Where because of the power vested in the shareholders, a business trust is in legal contemplation a partnership. What did they just say? Because of the power control vested in the shareholders, its property has been held to be taxable according to the statute relating to the taxation of the property of partnerships. However, where the title to trust property and the exclusive management of its business are vested in the trustees, free from any control by the shareholders, and the rights of the shareholders are limited to each receiving his share of the profits during the continuation of the trust and of the corpus upon the termination of the trust, the organization is held to be a true trust and not to be taxable as a partnership under such tax statute. A business trust has been held not to be subject to a tax on all moneyed or stock corporations deriving an income or profit from their capital or otherwise, or to a tax imposed upon the capital stock of all companies incorporated by or under the law of the state or incorporated by any other state and doing business in the taxing state. So that's the Foreign Corporations Tax Acts that most states have. However, the definition of the term corporation in a taxing statute may be so framed as to include business trust. Thus, a business trust has been held subject to state income tax as a corporation rather than as an individual, where the statute defined corporations as including, again, associations, and the Constitution defined corporations as including all associations having any power or privileges not possessed by individuals. And this is for everyone who wishes to create some type of private organization, private member association, or whatever else. The key terms here are associations. If you create one, what did these people just say to you? The footnotes don't have nothing. The personal property of a business trust was held to be taxable under a statute providing for the taxation of property of partnerships. Section 85, franchise or excise tax. A statute imposing a franchise tax on corporation and defining the term corporations as including any business conducted by trustees where an interest of ownership is evidenced by certificates or other written instruments is not unconstitutional. So too, a state legislator has been deemed to have the power to impose a tax upon business trusts as such for the privilege of doing business within the state, and to provide that such tax shall be measured by the net income of the trust. On the other hand, since the business trust has its origin in the common law right of the parties to enter in the contract, and this is what I've been saying, the term common law trust is a misnomer. There is no such thing, right? It's only trust all are applicable only and in equity. Common law has nothing. The concept is your common law right. Your right to contract is recognized as common law and does not spring from a franchise granted by the state. What did they just say here? It has been held that constitutional authority to levy excises upon commodities, a term including a corporate franchise, does not empower the legislator to impose an excise tax upon business trusts measured by the value of the shares. Because it's personal property, they're not commodities as like a Twinkie or something, for lack of a better object. The trustees of a business trust are liable for sales tax duly leveled against the trust. And you have to understand, in this context here, right, you're either structured in such a way that you're a corporation, partnership, or some other statutory entity, or your activity is in the public, or your activity is literally governed by them, meaning it's part of one of the delegated powers that we as the people conceded to either state and federal government. Footnotes, they don't really give no good footnotes. Where in the apportionment of corporate franchise taxes between state and local governments, the state's share is determined by the percentage of corporate stock held by non-residents, and all of the stock upon which the tax is levied is held by the trustees of a business trust. It has been held that the residence of the trustees, rather than that of the shareholders of the trust, will govern the division. Holding further that the fact that unanimous action of all trustees, resident and non-resident alike, would be required to sell or convey any of the property of the trust does not affect this result. Permissions, right? They're saying that the requirement for all the trustees to sign off don't mean nothing, right? It doesn't change the fact that it's they created a tax liability. Footnote 7, the definition of business trust in the statute imposing such tax as including every arrangement whereby property is conveyed to trustees associated together with similar or greater powers than directors of a corporation does not indicate that such tax shall not apply to an organization having only a single trustee, if otherwise within the statute. And there is a concept that you could be construed as an associate, even if you're by yourself, right? There's an Illinois court case that I have. I don't have it on hand right now, but there's a court case that, matter of fact, I think I pinned it or shared it at least. So if you scroll up in my Telegram group, it's screenshot, it's pictures that I took off my phone because it's in a book that I have for Illinois. You'll find it there. For the purposes of such a statute, the term doing business means actively engaging in any transaction for the purpose of financial or pecuniary profit, gain or profit. But you have to understand too that these taxes, right, if they're income taxes, right, this is specific and it involves corporate gain, corporate activities, corporate structure, and whatever else. That's what that means. The definition of income under these statutes for income taxation is based on corporate, what I just said. Everything corporate. In addition to the source of income. So you might not be corporate, but you might be doing business or receiving some form of income from a corporate entity. The source of income. Bruce Shaber was a factor that. The fact that the legislator has enacted regulations governing such trust is held not to constitute this method of doing business a franchise or privilege from the government so as to subject such trust to an excise. So an excise tax. This is Opinions of Justices. It says Supra. Opinions of Justices. Do I have this? American Law Review, Volume 63. I might have that. Let's see what they're talking about. I think I have this, but it's on my phone, on my other phone. I would have to see if this is it right here without actually reading it now. Yeah, it is. The transaction of a business in an association, partnership, or trust, the beneficial. All right, I'm going to read that. After I'm, just so you guys know, after I am done with this book, with this chapter, right, this business trust chapter, I am going to continue making videos based on business trust, but more than likely, it's going to be from other law books, right, or authors of these type of books, and court cases. So, especially important ones, the ones that separate private from public, taxation, whatever else, right? I'll figure out which ones as we go, and I'll add it in such a way to my videos to where, say, my first video was called Business Trust Part 1, right? Well, then I'll make a Part 2 to that. And a sub Part 1 and a sub Part 2. That's how I think I'm gonna do that, so this way they stick together in some way. Like you have a reference on a chain under the same topics that I just read to you, but the chain will be latched onto court cases and law reviews and whatever else that I choose. The fact that the legislator has enacted regulations governing such trusts is held not to constitute this method of doing business. I just read this. Franchise or privilege from the government as to subject the trust to an excise. So that's what I'm going to read. The feature of transferability of interest of members of a business trust cannot be called a commodity subject to a special excise tax. And this is a good case right here, Gleason versus McCabe. But even though I recommend that you guys read these cases, right? Man, you have to find these cases in your state. No bull. Or at least in the state that you're choosing to create this form of organization. The amount of sales tax duly levied by the state board of equalization upon a retailer, which is a business trust, is a claim on which the trustees are personally liable under the general rule that trustees of such trust are personally liable for the obligations of their trust, except with specifically exempted, either expressly or by implication. This has to do with sales tax because they call them a retailer. But because it's a general rule. In ordinary trust, trustees are held liable until what? Contract law steps in, and you, as the grantor, have every right to organize your the rules, regulations, and laws to govern your property. And if you so choose that you want to give this person, this trustee, limited liability or no liability at all, and they look at the trust assets for that remedy, then that's how it is. That's your choice, right? Section 86, taxation of shares or dividends. The shares in a business trust have been held not to be taxable as stocks in a money corporation. A state cannot, under the Due Process Clause of the 14th Amendment, tax as investments or intangible property of a resident of a state transferable certificates of beneficial interest under a declaration of trust, entitling the holder to a proportionate share of the rents derived from specified parcels of real estate in other states, and to share in the proceeds of any sale of the property. Although the trustee holds the property free from control by certificate holders, and the latter have no voice in the management of the property, meaning the shareholders, the certificate of shares in a business trust organized in another state, the rest of which consisted of real property located in the other state, has been held not to be a security, subject to an intangible personal property tax, but rather a muniment of title to an equitable interest in the trust property. And what is muniment? It comes down to you making your own. Let's see what it comes up with. Muniment of title. A muniment or muniment of title is a legal term for a document, deed, or other evidence that indicates ownership of an asset. Now, they say it like this here, right? But if you create this form of organization that we're talking about, right? Who do you think creates these muniments? Who do you think creates these shares or certificates that reflect those shares? You do. This right here is a power that you have to create, just like a birth certificate. If you never go to the hospital and have a home birth, you have the power to create these evidences of whatever it is that you're trying to evidence. And where a business trust was formed to deal in mineral lands and leases, with absolute control vested in the trustee, the holders of the trust certificates were entitled merely to receive such profits as were paid to them, unaffected by any such relation as to that of partnership or joint stock associations. It was held that the individual interests of the beneficiaries were not subject to taxation under a statute providing that all property, whether real or personal, in the state, and all monies, credits, investments, and bonds, stocks, joint stock companies, or otherwise, should be subject to taxation. However, dividends from a business trust have been held taxable under the state income tax statute, providing that the term dividends should mean all dividends derived from stocks, whether paid to its shareholders in cash or in property of the corporation, and defining corporations as including corporations, joint stock companies, associations, or common law trusts organized or conducted for profit. So here, they specifically included this. So there's a bunch that don't state this like this, but law is recognized as a science. They don't put words in there that don't have no meaning. Everything has to have a meaning, and there is no way around that. That's why you can't use definitions from other titles, other books, law, dictionary, none of that shit. If they gave you the definition, dude, then that's the definition. Like, you might be able to broaden it, might make yourself more knowledgeable of the definition by gaining a different variety, different senses of the word, right? But nonetheless, they could have 100 senses, but, like you or me, right? If you write a contract and you define a word, and that word in Black's Law Dictionary has 100 senses, am I right to assume that you meant every single one of them? Or are you correct, or am I correct to assume that you only meant one of them? Which one would it be? And that's what I believe, that most people are confused, or confusion is created because of these terms that they use, that they learn from somewhere else, that have no application to what it is that they're reading at that very moment. Inheritance, estate, and succession tax on shares in business trust are treated in another article, and that's, I think, still up ahead. See inheritance. Oh no, that's a whole other book. So inheritance, estate, and succession, revised edition, and it's section 286. I don't know what this is though, unless, I don't know. I'm guessing this is the name of the book, and it's the revised edition, if I had to guess. So the footnotes, holding that the organization was in the nature of a partnership and was not a corporation. invalid as a tax upon interest in land outside the state. The court held that the phrase or otherwise was to be construed in accordance with the rule of e jus dem generis. Let's look that word up. I never seen that one. I know what generis means. That's just its own category. E jus dem generis is a Latin word of same kind. When a law lists classes of persons or things, this concept is used to clarify such a list. For example, if a law refers to automobiles, trucks, tractors, motorcycles, and other motor-powered vehicles, a court might use this term, e jus dem, to hold that such, I don't want to click it, but you guys get the meaning. So here, when you read the word person, right, you have corporation, individual, trust, association, joint stock company, right? This falls under that category right there. Under this term that they're using here. And the word individual does not mean a natural person, since all the rest of them are artificial persons. And this is why also the term include and including, right, are both expansive and restrictive. They are restrictive that they cannot escape their class. In this case, artificial person. They're expansive, meaning that if they just use the word corporation, then it's expansive to all those other classes that are similar to corporations. That's how that works. Pointed out that the beneficiaries under the Declaration of Trust were not stockholders in any corporation or joint stock company, and stated that the instrument disclosed a purpose not to create any artificial entity separate and apart from real owners. So this is going to be section or subsection B, subsection 87 generally. A large amount of litigation has arisen under the provision of the Federal Revenue Act that the term corporation includes associations, joint stock companies, and insurance companies, involving the question of what constitutes an association within the meaning thereof. This inquiry usually arises in connection with the question whether an association is subject to federal income taxation on the same basis as a corporation, in view of the definition of the corporation for the purposes of the Internal Revenue Code as including associations, joint stock companies, and insurance companies. Business trusts are generally taxable under the Internal Revenue Code, being usually included in the term association for the purposes of federal taxation, and being specifically mentioned in the Treasury regulations as included, where they are created for the purpose of engaging in business for profit. And this is important, right? This Treasury regulation, because they use the definition, a common law definition for association. They don't use the corporate structure purpose of it. They use the common law version of it, which is, of course, natural persons coming together, putting up money for the purpose of engaging in a business for, to make money, to make profit. And although that it's irrelevant to this part or this portion right here, the word employee is similar. We do know that every single one of them, reflect the officer of a corporation, right? But in the end, they do also include the common law definition of what an employee is. But still, that just means that he's not a corporate entity as an employee, like use of the social, right? So that means that as a natural person, he can be an employee under federal law, right? But it's under the common law feature of it. As hard as that sounds to hear, that's a fact. I don't know how else to say that. Oh, but you also have to understand that even though they use the common law definition of that term, right, for employee, it doesn't mean everybody. It still falls to the primary source of that definition, which means an officer of a corporation. So if you're an officer of a corporation, well, there you go. Common law principle or not, statute principle, statute definition, or whatever, you fall under that. You're an officer of a corporation. The question is do you, right? The nature of a business trust for this purpose is determined by different tests from those applicable in other situations. A finding by the Board Tax of Appeals that a trust is not engaged in business in such a manner as to be an association within the Revenue Act has been held not to be conclusive on appeal. That would have to be specific. You have to read that court case. Sums paid by trustees of a business trust to a state as income taxes on dividends paid by the trust to shareholders in the state pursuant to a trust instrument providing for the payment of taxes on dividends out of the surplus or net profit of the trust are not deductible by the trust as ordinary and necessary expenses, business expenses, in computing its federal income tax, where the trust was under no obligation to make the payments except out of the earnings out of the earnings or profits. An act of Congress imposing a stamp tax upon the issuance of certificates of stock of an association, company, or corporation has been held to apply to certificates of shares issued by a Massachusetts trust organized to engage in the business of manufacturing textiles. And I think this is what number is that? Number 4? Oh, no, I was thinking of a different case, but I read this one too. Those cases are all similar. I think it's going to be Malley versus the commissioner, I think is one. And the Federal Stamp Tax Act, the federal stamp tax was held to be payable on a conveyance made by trustees of a business trust to a new trust formed as part of its consolidation because it got transferred over. But I'm almost guaranteeing that this has to be in the context of being in the public. Generally see income taxes for number 16. What was that? Right here. For the term involving the question what constitutes an association. And they say first edition, 162. I'm assuming that they're referencing American jurisprudence here. And in this case, first edition, which I wish I had, but I don't. I have Merton's income tax law books and stuff like that for trust estates and individuals and so forth from the 1920s. Footnote 20. A business trust is included in a federal tax on corporations under 26 U.S.C. 7701A3, defining the term corporation as including associations, joint stock companies, and insurance companies, and a provision 26 U.S.C. 78A4 that the term domestic, when applied to a corporation or partnership, means created and organized in the United States. See, this right here is they don't state what it really means, right? Because I got 2 court cases that show this, right? So the terminology, right? Created and organized, right? It means created or organized in the United States. It actually means created by statute. That's what it really means. Doesn't mean in terms of location. It means created by the statute of that state or United States or whatever. It could be federal or state. And I'm shocked they don't have it here and they instead give you Heck versus Malley. It might be here, just might be lower. I don't know if it's here because this book is 1998, where mine, the two that I have, are much older. So I have had access to older court cases. And then from those older court cases, I'll go to the law library and shepherdize them to see what positive and negative effect that those cases have had over the years. And by doing so, will give me the more recent court cases. So it's a benefit, no doubt. Nor are such payments deductible as taxes imposed upon a shareholder of the corporation upon his interest as shareholder, which are paid by the corporation without reimbursement from the shareholder. Since the term interest relates to a tax upon the ownership of stock and not upon the income derived therefrom. Such a tax is not unconstitutional as discriminating against business organizations which do and in favor of those which do not issue certificates or shares. Because you don't have to issue them. Like you don't have to issue certificates of shares. Right? You could flat out declare specifically who those persons that will benefit, right? Whether they benefit from the income or benefit from the property and the sale of the property when it's all said and done, or both. So Section 88, tests for determining whether a trust is an association. And of course, there's a section, on the first video that I made, they talked about the attributes of what an association is. So using that plus now the test, should give you a reference to how this works. Various tests have been applied by the courts in determining whether a business trust is an association subject to federal taxes under the Internal Revenue Code. The most important single element to be considered in this respect is whether the enterprise is created for the transaction of business. So that's the first one. Considered in this respect is whether the enterprise is created for the transaction of business. That's just first, right? All the other criteria are subordinate to this primary and paramount test. The substance of the distinction between a non-taxable trust and a business trust, which is taxable as an association, lies in the intrinsic nature of the enterprise and the relation of the several associates thereto, rather than in the mere form of the association, which is the paperwork, right? Or in technical distinctions between corporations, partnerships, and the like. It is now settled that the degree of control which the beneficiaries of a trust may exercise over the trustees or over the business or property of the trust is not determinative. So in this case, right, for the test on association, the amount of control that the beneficiaries have is not determined like it is for partnerships. That's what they should have said here. So understand that. And that a business trust may be an association, although the trustees are free from the control of the beneficiaries. Neither is mere size important in determining whether a trust is an association, taxable as a corporation under the Revenue Acts. Indeed, it has been held that a trust may be an association under the statute, even though the certificates of beneficial interest are held only by one person, or there is only one trustee. The fact that a trust is engaged in a single enterprise or a limited number of operations does not necessarily prevent its being classified as an association within the statute. The status of a trust under the laws of the state in which it operates does not determine whether or not it is an association for the purposes of the Revenue Acts. The status of a trust under the laws of the state in which it operates does not determine whether or not it is an association for the purpose of the text. So they're saying the states have no say-so. It's federal law that has the say-so on what an association is. The term association, as used in the Revenue Act, does not require organization under a statute and is not limited to trust having statutory privileges. The fact that at the time the trust was organized, the trustee did not know who would become shareholders does not exclude a business trust from the operation of the statute on the theory that in such a case there were no associations. Just because the trustee didn't know doesn't mean that there was no associates. Whether or not a trust amounts to an association within the meaning of Federal Revenue Act depends in the final analysis upon the facts and circumstances of each case, individual case. So here, this whole section, at least this portion of it, right? They told you what is it, what it's not, right? What does not matter, right? Like it will be an association regardless. That's what they told us right here. And the very last sentence told us what? It will be determined at court. That each case is applicable. So once you understand what the attributes are of what makes up an association, well then this right here is a given to avoid and to pass this test. And this right here, like Morrissey versus the Commissioner. That's a 1935 case that everyone should be reading. They lay out the foundation. Basically, what they just stated right here is in that court cases. That's the foundation case that held that a business trust is the criteria of what how a business trust will be held as an association. The fact that there is a small number of beneficiary shareholders does not exclude a trust from the operation of the acts. The fact that there is a large number of beneficiaries has been held to be immaterial. It would be nice if they give us the opposite too, And that's what's important to understand context, because you have to pay attention to what they're not saying. Where a business trust was created by an instrument executed by one who is with his wife and sister had previously organized a corporation to take over his personal investments, and also by the wife and sister to which all of them transferred their stock in the corporation in exchange for stock in the trust, which used corporation stock to purchase the assets of the corporation, in which trust instruments such person was named as the sole trustee for life, with absolute power to the conduct the affairs of the trust, and absolute discretion as to the declaration of dividends, to select a manager or managers, and to increase its capital stock from time to time, and to dispose of such increase as he should see fit, and further providing that the shareholders have no right or title to the trust property, cannot call for partition or dissolution of the trust, and are to be absolved from personal liability to creditors, and that the death of the beneficiary should not dissolve the trust. Such a trust is an association within the Internal Revenue Code so as to be taxed as a separate entity, although the wife and sister of the sole trustee each held but one. Hear this? They held one of the 300,000 shares of its capital stock, and he held all the rest. So, of course, the grantor held all the other, almost 298,000 shares, right? 998 or whatever shares was the grantor as trustee. He held all those shares, 99% of them, and the wife and sister only held one apiece. Right? But this is what's important. What this judge is saying here, right, is look at all these other powers. Right? He's mentioning all these powers for a specific reason, because they are powers that are not discrete or only that are not what would be a word, attributable to an individual as to how an individual would work. These are powers to where a group of people would work together and so forth, like they mentioned above. This right here, reading this court case should be very important for everyone to read. And it's a California court case. Because they're telling you, look at all these things, and then look at how he's acting. The grantor shouldn't have shit. He made himself some type of an associate. You have the wife and sister that came together and put their funds together to create the thing. So the question would be this. If you by yourself have the funds and you created a business trust, right, and you specified the beneficiaries where they are not associated together in the investment of the trust, right, in the creation of it, the funding of it, or anything else, well, then you're missing a key qualification here that makes up an association. Which also makes it harder, too. So for those who think that this is an easy task here, the fact that only one piece of property is included in a trust is of no importance. I think I remember this one. I don't remember it. I know the name. I don't remember the case. Since they tied it together with Morrissey versus the commissioner, this must mean that they were hit with as an association too. Section 89, the business test. The most important single element to be considered as determining whether a trust is an association as to be taxable as a corporation under the Internal Revenue Code is whether the enterprise is created for the transaction of business. All the other criteria are subordinate to this primary and paramount test. The test is whether the trust is a business concern and whether the shareholders or trustees or both are operating it in an active business for profit. Generally, only those trusts are taxed as associations which are engaged in doing business for profit or income. The word business, as used in this connection, connotes a commercial or industrial establishment or enterprise as distinguished from property, and means the activity, the energy and capacity, and the opportunities by which results are reached. In this case, profitable. A trust is not deemed to be engaged in business within the meaning of this test if its sole and principal object and activities are 1. The preservation of specified property, 2. The liquidation of a trust estate, or 3. Distribution of income derived from another source. Meaning it's not a business enterprise source, right? The mere receipt of income by the trustee from trust property and the payment of charges and expenses does not constitute such business as to be characterized a trust as an association. Let me read that again. The mere receipt of income by the trustee from trust property, right, because it's passive income, and the payment of charges and expenses does not constitute such business as will characterize a trust as an association. The type of organization not intended to be included in the term associations for federal tax purposes are pure trust, that is, trust of traditional pattern under which property is conveyed by deed, will, or declaration for the benefit of named or described persons. In determining whether a particular trust is a business trust and hence taxable as an association, its resemblance in its powers and purpose to a pure trust is relevant. So its resemblance in its powers and purpose to a pure trust is relevant. But the mere presence of one or more of the elements usually attending a pure trust does not ipso facto characterize it as a pure trust, since some of the characteristics of such a trust may be adapted under some circumstances to business purpose as distinguished from a trust purpose. I don't like that they're excluding even though they're saying, like, okay, so say you're in court and a judge is reading your trust indenture. The first thing that he needs to look at is if it's a business venture. But that is just one thing, right? He now has to show, or the prosecutor has to show, that you are functioning in an association capacity, right? But the business structure first will allow them to keep going. If that business structure ain't there, then there can't be an association because there is no enterprise for profit at all. So there has to be an enterprise for profit first for them to keep going on the rest of their determination and in looking for those attributes that make up an association. And that's what's irritating right now about this section, because they're not using court cases that are relevant with those attributes that they have stated in, I don't know the exact section 7, 8, or 9 or something in this book, which is the first or second video. Business test supplement. Leased property constituted a business and caused trust to be treated as an association, taxed as corporation, where leases gave trustee option to receive rent, either in cash or in kind, in form of oil pumped from land. And he always chose to receive payments in kind, which he then sold to independent oil producers. Independent Oil Producers Agency pursuant to a 5-year renewable sales contract. So he was more like a, what do you call them now? Like a distributor or something, right? Where his source is from, of course, the source of where the property and or the item that he's trying to sell, but he buys it in bulk. But then that person that bought it, the distributor, he has the shit ton of customers to sell it to, but he also sells it like in bulk also, right? But in smaller sizes than what he bought it in. Right? That's how I see this, at least, without reading that court. I don't know that court case. Footnotes. To permit a trust to be classified as an association for income tax purposes, it must, 1, be initially created or have been thereafter utilized as a vehicle for carrying on a business enterprise. And it must, 2, have characteristics under its written structure or its adopted mode of operation resemblant of a corporate. See, this is what I was looking for. Here they told you the first thing has to be what? You're a vehicle for carrying on business. But the second part, for them to continue in their investigation, you have to have what? The characteristics of a corporate organization. Both of these features are requisites. However, the first is the substantive element, and the second is simply one of supportive, but not invariable form. So this right here, they should have had somewhere up here. And more thoroughly, in my opinion. This is what I think is. I'm pretty sure it's more thoroughly in the other ones. It's because, after 1935, the Morrissey case, right? You had more specific opinions from judges, and those opinions from those judges were inserted in those earlier books than it is here. There must be an engagement of capital in the transaction of business for profit. Since I don't know this case offhand, let's look it up. This might be, one of the cases I end up, reading. But this is, I heard Case Text, they were bought out by LexisNexis. for whatever that's worth, right? At least last time I went to one of the seminars at the law library, there was an individual there who mentioned that he was asking the lady because she works for LexisNexis, and she was showing us the tools on LexisNexis, and he brought that up, and you're going to see a lot of similarities on how they report or how they, for your consumption, these court cases, how they write it up and stuff, and what's missing, what's not missing. There must be an engagement of capital in the transaction of business for profit. The term association is used in this connection to indicate a collection of persons who have united or joined together for some business purpose and who act together without a charter, but use methods and forms of corporate bodies in the prosecution of some business enterprise for profit. But look at the key term here. Connection, to indicate a collection of persons who have united or joined together. So if you by yourself don't have this, right? You don't have this attribute where you're an associate. You just have to avoid that single trustee or single beneficiary type associate aspect of it, whichever that might be in the state that you want to create it in. So you have to understand that's important. People who want to believe that their statutes don't apply to them are complete morons. A business trust holding a stock of a group of mining corporations and furnishing them directional and policy-making services has been held engaged in business for federal tax purposes. So they hit the stockholders. They held the stockholders as associates and hit them for that tax. The business trust organized to conduct a general plumbing business having continuity of existence, centralized management, and provision for transferable shares have been held in association taxable as a corporation. And this is important, man, because these attributes right here, continuity, right, of existence, centralized management, and stuff like that, those are things that are considered corporate. I mean, they might be a benefit for like myself, right? But the thing is, I have to understand what is the original principles of just trust law. Anything outside of that, that's why you have to go look up and read books on corporations and associations and look up specifically what are the attributes that make this up. Some are going to be similar and some are not. You use the ones that are not. Well, there you go. You just add it to your list. If you're on a teeter-totter, you're trying to be balanced or leaning more to the trust side, well, damn, if you grab a corporate power, you just raise yourself up. You grabbed another one. Now who's heavier? The corporate side. Understanding what power that you're writing in your document is absolutely important. Stating that the mere receipt of income and its distribution amounts to no more than receiving the ordinary fruits arising from the ownership of property. So this right here was not an association, if I'm guessing this right. I think I did read this case, Gibbs versus Prayer. This looks very familiar. So stating that the mere receipt, right? Yeah, stating that the mere receipt and distribution amounts does not constitute an association. So that's passive income. You're not actively engaged in some form of business. In an ordinary trust, the beneficiaries are of no real sense associated in the conduct of the trust affairs, and consequently, an ordinary trust does not become an association within the meaning of the Revenue Act. So this is under this right here. As a principle of trust law, beneficiaries have no powers in the trust affairs. This is where that principle comes from. So if the beneficiaries do have powers, to control or otherwise, that is a corporate power. So you guys understand that is an attribute of corporations. Because if you have invested in stocks in any way, or even own or created a corporation in the past, right, or currently now, then shareholders have a fucking say-so. That's a given. They have a say-so. But they have a say-so that's determining that, everyone has a say-so. But to move the party, right, like there might be a regulation for it, though, meaning 75% of all shareholders agreeing, boom, they move the party, right? They move that line or whatever. They execute that power. Associated in the conduct of the trust affairs, and consequently an ordinary trust does not become an association within the meaning of a revenue act. So it sounds like here they try to hit a regular trust that was making passive income. But where the creators of the trust, who were also beneficiaries, are using it to pool their common interest for the purpose of conducting a joint business enterprise for their own profit, the trust is not an ordinary trust, but merely an instrumentality used by the associates to obtain some corporate advantage for their business venture, and the beneficiaries are, in reality, the promoters of the business venture. And this is going to be the corpus similitude. So this is the one that's going to be, you look like a corporation. I believe this is the last thing too. Two more. Like 3 more pages. I think this is getting kind of long already. I probably hit the 1 hour marker already. It is what it is. I'd rather not separate 2 videos for the taxation portion. The inclusion of associations in the definition of the term corporation, as used in the revenue code. Sorry, this is section 90, corporate similarities, right? Implies some resemblance between the two. But it is resemblance and not identity which is contemplated, and definitions are not to be pressed so far as to make formal procedure a controlling test. While use of corporate forms may furnish persuasive evidence of the existence of an association, the absence of particular forms or of the usual terminology, so words, right? Words are not decisive. The question of the taxability of the trust as an association does not turn merely upon technical differences between the trust and a corporation in respect to their organizational structures. The detriment is rather the approximation of corporate advantages by the use of a trust instead of a corporation. It has been said regarding the corporate analogy that there should be a balancing of resemblances and contrast and effect given to the dominant functions and attributes of the organization. So again, a teeter-totter, right? Effect given to the dominant functions. So if you have more corporate functions than you do trust, like I said, some are going to be the same on both sides, right? But when you start using the ones that don't apply to the other, well, there you go. And I guarantee this should have Morrissey versus Commissioner, yeah? And there it is. In determining whether a trust amounts to an association within the meaning of the Federal Revenue Acts, it is unimportant, or at least it is not controlling, that meetings are not held by the beneficiaries and that the trust has no office, place of business, seal, bylaws, or official name. Or that there are no formal meetings of trustees or directors, or that their organization is of a loose or informal character. The test of an association is not to be found in the mere form of the evidences of certificates of interest or in any particular method of transfer. And it is unimportant that no formal certificates of ownership were issued. The name given to the evidences of interest or to the beneficiaries is unimportant. So that's all they're saying is forms. The form, right? They're looking for the substance. They're telling you the form don't mean shit here. Limitation of the beneficiary's liability is not a sine qua non. I don't know what this is. Sine qua non. An essential condition. A thing that is absolutely necessary. So limitation of the beneficiary's liability is not essential of corporate analogy. And the absence of such limitations does not necessarily preclude the status of association. And that's because it's only one. It's only one attribute. Limitation of liability and stuff, like, that's only one attribute. You got to have more than one. Illinois is like that. Like, they tell you, like, if the beneficiaries have the power to amend, right? But then it's restricted to certain aspects only. Well, that right there don't constitute nothing. But then if you gave them the power to remove trustees, okay, well, now you have two powers that they should not have together. You know, or if, I know, like, here in Illinois, like, you could have at least two powers, right? But the powers are in such a rare event, right, that it doesn't determine that it's controlling. Like, it doesn't create an association or a partnership or anything like that. It's just the likeliness. In some states, they don't care. Just that you wrote it and it's never been exercised, they'll use it against you. But here in Illinois, it's not really like that. There's some leeway to that. It, like I said, it depends on the jurisdiction you're making this in. And as continuity of organization is an attribute of trust as well as corporations. This feature is not sufficient in itself to characterize a trust as an association. So then, like I said, yeah, it's important to find out what the attributes are to trust, what are attributes to corporations, partnerships, and whatever else. The same is true of the existence of the right to transfer beneficial interest. While the use of corporate forms by a trust or the inclusion therein of other features similar to those of ordinary corporations may furnish evidence that the trust is an association, this is not a conclusive test. It is not essential to bring a trust within the definition of a corporation for federal tax purposes that the organization be identical in its structure and functioning to the corporation. So it doesn't have to have them all. Like if there's 5 attributes that determine what a corporation is, well, you don't have to have them all. At least here in California, right? Since this is a California case. You can have 3, you can have 2, you can have 1, and they might screw you. I don't really know California like that to know. I know some. So I was researching it for someone, and then they chose not to learn shit, so I dropped out of researching anything for them. The significant resemblance between business trusts and corporations for the purposes of these statutes does not lie in the formality of meetings or records, but in the fact that by virtue of an arrangement for the conduct of business of a joint enterprise, the parties have secured centralized management through designated representatives. Where the trust has a governing directorate and carries on its business in a corporate-like form, it is an association within the Revenue Act, even though the liability of the shareholders is as a partnership. And they look at everything. What is this right here? Are they just talking about a director? A board of directors. So having a board, look at least here in California, well, this is a federal case out of the district in California, where the trust has governing board of directors and carries on its business in a corporate-like form. So they added more. And carry on its business in a corporate-like form is an association. 91, terms of trust instrument or activities of trustees. Although there is an authority to the contrary in some of the earlier lower court decisions on the subject, the Supreme Court of the United States has ruled that the character of a trust as an association for federal tax purposes is governed by the terms of the trust instrument, since the powers of the trustees can be exercised by them to the full extent therein permitted, and that for the purpose of avoiding taxation as an association, the parties are not at liberty to say that their purpose was other or narrower than that which they formally set forth in the instrument under which their activities were conducted. So it's like you can't say that your purpose was something else when the trust instrument, the contract, is saying something different. At least in that section right there. But it's governed by the terms of the trust because this is where the substance is at. Right? The powers that you have. It's not names. It's not what you call something or all that other shit, right? It's the substance of the thing. How else are they going to determine that you have corporate attributes? In other words, whether there is an association for the purpose of carrying on a business is to be determined from the trust instrument itself, from what could be done under the trust, and not from what was actually done, or what the parties to the instrument thought they could do. The legal effect of the instrument is controlling, as against the direct affirmation, disavowals, or protestations embodied in the instrument. So that the fact that the organization in question has consistently called itself a trust is of little or no significance in determining its true character under the revenue laws. You could call yourself whatever you want. They call these things syndicates also. It doesn't matter what the name is. It's the substance. Substance, the context, whatever, right? That's what matters. What you call it don't mean shit. Moreover, where a trust has the characteristics as well as the powers of a business trust, it cannot escape taxation by the failure to exercise such powers during the taxing period, or by declining to exercise them, since the trustees could, if they so choose, to exercise them. And a lot of this, like I said, is going to be dependent on the jurisdiction that you're in. In some, I'm guessing California and probably Texas, the mere existence of the power is what determines something. On the other hand, a consideration of what the trustees actually do is not necessarily inconsistent with the foregoing principles. The actual activities of the trustees may be pertinent to show that the parties contemplated that the trust should engage in business in such manner that if the purpose were expressed in the trust instrument, it would clearly be an association for the purpose of taxation, and that they adopted the trust form as a device to escape taxation. Conversely, considering the terms of the trust instrument, it would seem clear that if, on its face, the instrument describes an ordinary trust, such as is appropriate and customary for the conservation and distribution of the estate for the benefit of sestique trustant, and there is no purpose or power to engage in business specifically or formally set forth in the trust instrument, nor actual exercise of such powers by the trustees, the mere fact that the powers conferred upon the trustees may be sufficiently broad and general to include the power to engage in business to some extent will not convert the trust into an association within the meaning of the Revenue Acts. So that's a big one. Right? I would like to read that again. Let's see from where. Let's go right here. Conversely, considering the terms of the trust instrument, it would seem clear that if, on its face, the trust instrument describes an ordinary trust, such as is appropriate and customary for the conservation and distribution of an estate for the benefit of sestacute trusted, which is just beneficiaries, and there is no purpose or power to engage in business specifically or formally set forth in the trust instrument, nor actual exercise of such powers by the trustees, the mere fact that the powers conferred upon the trustees may be sufficiently broad and general to include the power to engage in business, to some extent will not convert the trust into association within the meaning. And that's important, right? Because just because you have the power to start a business doesn't mean that you are actively in a business. So after all that wording right here, this last sentence is probably the more controlling one. Moreover, if the instrument is ambiguous, the practical interpretation thereof by the parties, right? So not legalese, right? Practical interpretation thereof of the parties, as exemplified by the actions of the trustees here thereunder, may be examined for the purpose of ascertaining the true meaning of the instrument and the nature of the trust contemplated thereby. And the reason why this is important, right? The practical interpretation thereof, right? It is because it is the grantor's intent, and then how that intent is interpreted by whoever is running the trust, right? This has nothing to do with statutes or anything else. They might be trying to hit you with a statute, but it's the contract that governs. That's what people need to understand. It's the contract that governs. And they give Marcy Commissioner again, holding a trust taxable as an association, notwithstanding the fact that the sale of real estate by the trust in question was made before the beginning of the tax year, and that its remaining property was conveyed to a corporation in exchange for stock of the latter. So that's because they're saying that the trust was an association, so it don't matter if they got rid of the property or not. It says to the like effect. See, I got to read this case because that's the one I saved. So that's footnote 20, which is this one. Right? And for the purpose of avoiding taxation as in associations, the parties are not at liberty to say that their purpose was other, right, like bigger, right, or narrower than that which they formally set forth in the instrument. So they're associates because they created it together, under which their activities were conducted. Whether a business trust is an association within the meaning of the Internal Revenue Code, so as to be taxable as an entity separate from the sole beneficiary, is to be determined from the four corners of the trust instrument and not from what the beneficiary may claim. The contract is what governs. The intent is what governs. The nature of the trust is to be determined not by the intentions or expectations of the parties, except the grantor, right? So they're talking about, trustees or the beneficiaries, as shown by parole testimony, nor primarily by the extent to which the powers created by the trust have been actually exercised, but by the purpose and potential activities as disclosed on the face of the instrument. Again, California case. That's why they write the word potential here. Because even if you write it down, It's added to that list of corporate activities. The character of the association is determined from the instrument, and it is no defense to say that the managers did not exercise all the power set forth in the Declaration of Trust. Footnote 7. It is not necessary to assume from the recent decisions that the language of the trust instrument as to purpose will be conclusive in all cases, or that actual activities or unexpressed purposes always will be irrelevant. But when the expressed objectives and powers are appropriate to conducting a business enterprise, and all or most of them actually are carried out and exercised, the existence of an unexpressed intention not to engage in business cannot counteract their effects and amounts to no more than a misconception of the nature of the activity or an intention to escape taxation. There are circumstances in which the distinction of function is so shadowy that the technical arrangements entered into must be controlling, and that is true though the parties may not have understood them and have their consequences fully, or had actual intentions which were contradictory. Almost all these court cases are California, which is disappointing because that's like severely limiting from 50 fucking states. You know what I'm saying? So this is a good case too. Helvering versus Coleman. This deals with two things too: income taxes, associations. They were hit an association. This is apparently the sense in which this language was used in Helvering. So let's look at footnote number 10. Right here. It would seem clear that if on the face of the instrument describes an ordinary trust such as appropriate and customary for the conversion and distribution of an estate for the benefit of beneficiaries, and there is no purpose or power to engage in business specifically or formally set forth in the trust instrument. So they were not hit in an association. Assuming that what I just read is coming out of that case, which I think it is. All right, and that is all for today. So far, we have hit 137 pages out of 164. I'm thinking maybe 2 more videos. So the next section is going to be Section 9, Termination and Dissolution. Right, let's see if there's another section. Receivership, reorganization, or merger. So those are going to be the last 2 sections and probably the last 2 videos. There's another one I might include because it's only 30 pages. So, see, practice and procedure. So this is court stuff. So maybe be 3 pages because I wouldn't mind just tackling this on its own, even though it's probably going to be really short. I wonder if the rest of this is going to be practice and procedure. It looks like it. Shareholder, yeah. So the rest of this is all court stuff. So that might be a video unto itself, and that's a lot. You guys can see 15, 20 pages comes down to like 45 minutes to an hour. So this right here is 17 pages. So 2, maybe 3 more videos. All right. Hope you guys enjoyed that, understood some things. I'm always open to questions if you guys have any. But, it is what it is. Hopefully you guys can like and subscribe to my channel, to the Butterfly Monkey channel. And I'll see you on the next video. Take care.